Hey everyone, good evening, good afternoon, good morning from wherever you're watching me from and also listening to the sound of my voice from. Welcome to the live trading session with Octa. My name is Ambrose Ebuka. Now, before I go into the details of today's session and get this live trading session started, let me know in the comments your name and where you're watching me from. Let's get to know ourselves. Let me know in the comments. You can go ahead and use the live chat and comment your name and where you're watching me from. Let me know in the comments, guys. And I'll just run through the disclaimer while you do that. Any opinion, news, research, prices, analysis, or other information discussed in this webinar or linked to this presentation is provided as general market commentary and does not constitute investment advice. Now, guys, let me know where you're watching me from. What's your name? Where you're watching me from? And again, if this is your first time participating in a live trading session or an Octa webinar, you can go ahead and let me know in the chat as well. Let's see if we have some first timers in the house. Okay, we have Aaron from Ghana. Welcome to the session. And while we wait for a few more persons to join, I'll just go ahead and talk to you guys about myself. My name is Ambrose Ebuka. I have 6 years experience in the markets and I trade with precision, blending swing and scalp trading setups to stay consistently informed in the financial markets. I'm mainly focused on gold, GBP JPY and GBP USD, where I hit above 85% accuracy and I backtest every time to stay razor sharp in these markets. Guys, if you're just joining, welcome to the Octa live trading session. My name is Ambrose. I just did a quick introduction about myself. You can go ahead and let me know about yourself in the chat as well. If this is your first time, let me know in the chat. And if you're just joining, I want you guys to take a moment and ask yourself this question, right? Are you trading in the financial markets to win, or are you just hoping not to lose? Because there's a difference, right? The truth is, a lot of traders, especially the beginner traders that just get started, they're showing up every day, entering trades, watching charts, but they don't have any structure. And that's why we are here today to teach you about trading structure. So if you're feeling like you show up but you don't have, or you're not getting the results that you want, you're not behind, you're not slow, you just need rhythm. Now, this session is very important because we're not just going to be marking support and resistance levels. We're not going to be looking at the candlesticks, go up and down. I'm going to show you guys something bigger, which is what I also like to talk about every single time I start my session. I'll talk to you guys about how the economic calendar can help you trade with purpose, not guesswork. Okay, let me know in the chat. How many of you guys check the economic calendar before placing a trade? Let me know in the chat. Do you check the economic calendar before placing a trade? Yes or no? Let me know in the chat, guys. Do you check the economic calendar before placing a trade? Let me know in the chat, guys. I think I have to use this one because I can't really see the chat from here, so I have to use it on my screen. Blessed Links Enterprises, it's his first time watching from Lagos. Welcome. Theo, welcome. Chukasin Global, welcome. Chukasin Global says he doesn't use the economic calendar to check to check the economic events before placing a trade. He doesn't even know the economic calendar. I mean, that's honesty right there, and it's good because at the end of the day, you get to understand what it is and how you can use it to your own advantage in today's session, right? Aaron says that's the first thing I do before I even go to the charts to do my analysis, which is awesome. Akinwumi can't hear me, guys. If you can hear me, please let me know in the chat. That the mic is pretty good, guys. We're not gonna have mic issues today, but if you guys can hear me, let me know in the chat, okay? Nasdaq, we'll do a review on that. Okay, all right. I think I can see it here as well. So let's just I'll just look at it from here. Now, if you've ever opened a trade and price moved violently or fast against you within seconds, it's probably not your strategy or your fault. It could be news that has been scheduled to happen at that time that you did not see. But if you had checked the economic calendar, you could have seen it and prepared yourself for that news. And today I'm going to talk to you guys about the economic calendar in itself and how you can use it to merge with technical analysis and understand market structure properly. But before I do that, I'm going to ask you guys another question and then we're going to get started. What is one thing that you struggle with the most in trading right now? Let me know in the chat. What's one thing that you struggle with in trading right now? Let me know in the chat, guys. What's one thing that you struggle? It could be lack of discipline. It could be greed. It could be over trading, over leveraging, revenge trading. Whatever it is. It could be psychology. Whatever it is, let me know in the chat. And we're also going to be talking about zone trading today. I'll introduce you guys to zone trading, how you can catch trades at key levels, significant levels. We'll look at the DXY, which is the dollar index, and the correlation with other pairs as well. And we're going to talk about something that has to do with the power of rhythm, right? The power of rhythm. And then I'll take your questions and I'll also ask you guys questions as well. Ajayi says, the one thing I struggle with is fear of missing out. And just after that, Ella says the same thing, fear of placing my setup. Almost the same thing, fear of missing out, fear of placing setup. Chickerson says, spotting support and resistance level is the thing that I struggle with in the market. Guys, we're going to look at all these things today, and I believe that at the end of today's session, you understand how to overcome these things. But what I want you guys to grasp from today's session is that when you want to stop a habit in trading that doesn't align with your goals, that would not get you results, you have to remember that you would replace that habit with something else. For example, if you want to stop over leveraging, you need to introduce a trading plan. If you want to stop, consequent giving back the market profit you make, you need to introduce a withdrawal plan. So you can't just wake up and say, oh, I want to stop FOMO. Okay, so what are you going to be doing? Nothing. That's not how it's going to work. But after this session, you're going to learn all those things, and I'll give you guys some tips on how you can overcome all that as well. Remember, you're not behind, you just need rhythm. Okay? You don't need to catch every single move in the market. You just need to learn when to move with intention. So when I say you just need rhythm, that's what I'm talking about. And when you match your rhythm with the market's timing, your trading becomes very powerful. Okay, today we're going to look at all the economic events, the jobless claims, productivity data. We'll look at all these numbers that tell you exactly how money is flowing in the real world. And if you understand how these things work, you stop trading in the dark. All right. Organizational issues, which is, what's going to be happening in this session. It will last for about 45 minutes out to an hour. I'll take your questions with an extra 15 minutes. And just like you guys are already doing, you can use the YouTube live chat to ask your questions during the webinar. I will periodically check it and answer them all. I find the support and resistance first. I tend to close a winning trade quicker than necessary, especially when there is a pullback. Okay. My trades have a way of going against me. When I buy, it goes the opposite way. Okay. Well, we're going to look at all these things. I believe that when I break down zone trading and help you guys understand what analyzing from the higher time frames to the lower time frames mean, then you'll be able to adjust on some of these mistakes that you're making. All right. Okay. So just a brief introduction to the zone trading strategy that I use. Now, how many of us have heard about zone trading? If you've heard about zone trading, let me know in the chat. If you've heard about zone trading, if you know what zone trading is, if you have an idea, you can say, yes, I do. If you don't, you can still let me know in the chat. I'll just give you guys an introduction to what it's about. Let me know in the chat. Have you heard about zone trading? Okay, all right, all right, all right. Now, imagine the market is like a war ground, a battlefield between the buyers and the sellers. That's the bull and the bears. Now, instead of trying to predict every candlestick, zone trading focuses on identifying the areas where the buyers and the sellers are likely to clash. And we call these zones ranges. They're not single price point, they're not one straight line. It's a zone, it's ranges. So you just see them as territory of interest, area of interest, point of interest, where these big moves tend to happen. Now, I see some people saying, I don't know what zone trading is. I believe that after this explanation I give you right now and the practice or the practical session I'm going to have with you, you'll be able to understand what zone trading is. Now, we have two types of zones, right? Two major types of zones. We have the demand zone, which is the buy zone, and the supply zone, which is the sell zone. Let me see if I can show you guys just a brief introduction for the beginners. Let's take this off. Okay, I think this one is clearer. All right, for this purpose, I'll just be taking some of these lines off. So everything is pretty clear for you guys to see. All right, perfect, perfect, perfect. Gold is still trading. We'll talk about gold later. Okay, so we have two types of zones. Now, if you look at this chart right here, you see we're coming from an uptrend, right? And zones, the demand and supply zones are also visible in a trending market as well. Okay, supply, demand, right? Supply, demand. You can see it here as well. But let's use the most obvious one, right? The demand zone is a price area where buying pressure is strong. The supply zone is a price area where selling pressure is strong or dominant. Now, if selling pressure is strong in the supply zone, is it going down? Let me know in the chat. If selling pressure is strong in the supply zone, is it going to be up or down? Where would you identify your supply zones? Because someone in the chat said, I find it difficult to identify support and resistance. This is a good step to understanding how to identify it. The supply zone is an area where selling pressure is strong. So would you be looking for supply zone above or below? Let me know in the chat. Yeah, I think above or below is the options you have, not up or down. Would you be looking for supply zone above or below? Let me know in the chat. Remember, supply zone is an area where selling pressure is strong. You know, the bears are saying this is too expensive, it's time to sell. The price tends to drop from there. The demand zone is an area where buying pressure is strong. It's where the bulls are saying, let's jump in, the price is too cheap, and price tends to bounce from the demand zone. So the question now is about the supply zone. Would you be looking for a supply zone above or below? Chikasen says above. Do we have any other person here? Now, because the supply zone is where selling pressure is strong, the supply zone is going to be above. Because for the market to sell, it has to come from above to below. So in this case, we're just going to identify these zones as our supply zones. And then the demand zone is an area where buying pressure is strong. So when you think of demand, the first thing when you see demand, the first thing you should think about is buying pressure, right? We have demand here. We have demand here. I know that you guys will be wondering why we skipped here to come down here. If you remember, we had market price action here, but we couldn't sustain that bounce, and the market went straight down to grab liquidity from where? This key level. If you're familiar with key levels, you would have capitalized on this gold move, because obviously the push to the downside, the retest, the rejection, sweep move. But this is on the daily time frame actually, so still something to capitalize on when you go to the lower time frames and join in this rejection, or wait for the confirmation of the rejection and still capitalize on the trade to the top side as well. Demand, and this is also demand, even though it's quite minor, but it's still demand. Now, I want you guys to understand something. Most of the lines you see here, I don't just draw them while the market is moving. Most of these lines have already been drawn, right? Most of these lines have already been drawn, and then the market is just acting according to these zones that I've mapped out. Now, I don't map out these zones, and I want you guys to also understand this as well, because if you're going to be trading key levels, you need to understand that you're only trying to identify possible areas of bounce or break. It is not a guarantee that if the market gets here, it's going to bounce, just like it did here, right? Now, imagine you had this zone mapped out. Okay, we had a breakout here. This is obviously an area of interest for you. We had a pullback. Area of interest has been confirmed. It's now even strong. It's not a guarantee. Anything can happen over here. It could be news. It could be anything. But because you mapped out this zone, it doesn't mean that whenever the market comes here, it's going to bounce. You're mapping it out because you want to create that awareness that, look, something happened here previously, right? And this zone became strong. So if we bounce here, I'm going to ride to the top side. If we break, I'm going to look for the next key level, the next area of interest. A minor one, because this is on the daily time frame, but if we go to the lower time frame, we will see that this was a minor one, right? A minor one will be this, and then the major one will be this, which obviously the markets tested, came down, grabbed liquidity to the top side. Now, just because you had the understanding of this level and this level, when the market was here, you would have noticed that there was no bullish momentum that took this market to the top side. There was no indication of buying presence. We had bearish, this emergence of a bullish candlestick, which is not engulfing, which doesn't also show momentum. And we saw the bears push us all the way to the downside. In fact, at the moment where this candlestick broke below the lows of these two previous candlesticks, you'd have had the indication that we're coming all the way down to retest here. And if we break here, we're coming down to retest here. Just by understanding how key levels work and how supply and demand works, you'll be able to capitalize on most of the opportunities that are in this market. Let me know in the chat if you're following. Let me know in the chat if you're following the session. So this is just a brief introduction to supply and demand, right? Like I said, it also works in trends. It's even simpler with trends because you just know that you're waiting for a pullback after an impulsive move, a pullback here, and then we connect this pullback with this. I normally use the daily time frame to actually identify these things. So price action here, retest, pullback, grab liquidity from this previous low. As you can see, boom, came down to grab it here from this previous week and push to the top side. Now, the idea and the objective of zone trading is not to be ahead, but to anticipate and be prepared. I want you guys to really understand this, because a lot of times when you learn most strategies, especially strategies like this, you just feel like, okay, I've drawn the line, it must test it must bounce, it must break. You can't be so sure until the market gets there and reacts. For example, if you look at this market right now, right, I had this trend line drawn. Let me take off this one so you guys can see it clearly. I had this trend line drawn, and then we saw how the market bounced and traded on it. It doesn't mean that it's going to continue to trade on that trend line until it gets to the top. If you notice here, for every time it bounced, we had a rejection. And after that rejection, there was a follow-up bullish momentum candlestick that showed us we were still going up. See this rejection, bullish momentum candlestick that closed above the highs of the previous bearish candlestick. Bullish momentum, right? But here, let me zoom in so you guys can see clearly. But here, we didn't have any bullish momentum. If you look, you see rejection, rejection candle, and a follow-up. For every rejection on this trend line, there was a follow-up, right? But here, I won't just go into the trade and say, oh, because you retested 3 times, you're going to retest here. And then when it doesn't retest, I start to pray, or I start to be hopeful. Hope is not a strategy in the markets. Hope is not a strategy in the markets, right? You have to trade what you see, not what you feel or what you think. Trade what you see. Now, if you look at this market, came down to make a test at this trend line, there was no bullish momentum that bounced up. Instead, we had a bearish break to the downside. Now, this bearish break came to make a retest at this previous low, this previous swing low, which is also a key level for us. I can even extend this all the way to this point. Came to retest it. The bullish momentum candlestick that formed here did not close above it. It did not take it back into the trend line. Let me give you guys another example. Let me show you what I mean by take it back into the trend line. If you look at this break that you have right here, you see we saw the gold market break to the downside, make a retest here, push back down, grab liquidity, push back up, and now we are seeing a bullish engulfing candlestick that takes us back into the range above the demand level, right? If we didn't see this, the market would have still continued to trade to the downside. And that is what we lacked here. We saw the market break, boom, push us back down. We didn't get a follow-up that took us into the trend line. Instead, we got another bearish momentum candlestick that took out this level, came down to make a retest here. Now, if we had a bearish candlestick here, if this was not a bullish candlestick and we had more bearish momentum, this is the next place we are coming to. This line and these ranges and these zones have given you an idea of what to expect. And then because you were expecting and you're anticipating, you just wait. And when the market acts, you react. Now, as the market is headed upwards, obviously we're expecting another retest here. But you don't just expect it to just start going straight upwards. You don't just say, okay, because we've broken up, then we're going to start going straight up. But most of the times, what moves market this way is news and volume. But now we are back trading above this trend line. If we sustain this bullish momentum above the trend line, I think I should just make it a bit dark. Then we'll be expecting a retest on gold at $3,430 per ounce. It's already getting to 3,400, which I believe is going to get to before the end of the week. And we only have tomorrow. Do I use any momentum indicator to confirm any reversal or entry? So I only use 3 indicators mostly. I don't even use them all the time, but if I'm unsure about an entry, maybe not unsure, but if I just need an extra confirmation on an entry, then I would use the moving average or the Fibonacci or the RSI. But I don't use them in isolation. I have to combine the feedback I'm getting from these indicators with price action, because these indicators that you see in these markets, they give you feedback of something that has already happened. That's what you need to know. They're not like instant, or they don't give you future price detail or information. The market has to be oversold before the RSI tells you it's oversold, right? So these are the indicators that I use. And let's get back to it. So what does the strategy consist? I just wanted to introduce you guys to zone trading and how it is built on supply and demand. As a matter of fact, I believe that most strategies are built on supply and demand, regardless of the name that is given to it. It's still built on supply and demand. The market moves based on supply and demand, and even outside of the market, businesses move based on supply and demand. Trends move based on supply and demand. If the demand for a certain outfit is high, the price tends to increase. You guys know what happens when there's fuel scarcity in the country, right? The demand increases, and what happens to the price? It goes up. But when you can buy the fuel everywhere, even on the street, you see that the price becomes affordable, right? Supply and demand, guys. So, what does the strategy consist of? Your understanding of the market structure, and for you to understand what market structure is just basically coming to the market and being able to identify initial trend or initial range, right? Just like I came to this market, yes, I have the lines mapped out already, but if I go to, let's say I zoom out, right, and then I want to hide all these things, I already know that this market is trending upwards, and then we're currently ranging between these highs and these lows, right? And usually when this happens, the longer this happens, the stronger the breakout. The longer the consolidation, the stronger the breakout. All right. So that's basically what it means when we say understanding of market structure, being able to identify, patterns with the candlestick chart, the trends, the ranges, supply and demand zones, support and resistance zones. And then you want to identify your key levels, right? These supply and demand zones are your key levels. Those trends and the trend lines are your key levels, okay? You can also use the Fibonacci to identify key levels, and you want to predetermine your entry and exit point. This is just a step or a flow for you that you can use, a framework, a structure that you can use while you execute your trades with the zone trading strategy, right? So you understand market structure, you identify the key levels, then you want to predetermine your entry and exit points. Now, I know a lot of you are guilty of this one, but you may not want to answer in the chat. Anyway, most traders just place buy trades and sell trades, and that's it. They don't know where they want to exit the trade or where they want to, close in profit or close in risk. They just place the trade and hope to make money. Other traders would place trades. They don't even look at the market structure. They just say, I'm placing this trade, I'm using 40 pips stop loss. I'm placing this trade, I'm using 20 pips stop loss. Guys, the market doesn't care how many stop loss you use. There is something called market structure and market condition for a reason. So when you want to place a trade, the market structure and the condition of the market, it can be your ATR, it can be your swing highs and lows, but the market has to determine where you want to exit in profit or set your risk. You don't just decide to use 20 pip stop loss for all your trades. When there's NFP, 20 pip stop loss. When there's CBI, 20 pip stop loss. FOMC, 20 pip stop loss. New York session, 20 pip stop loss. Overlapping session, 20 pip stop loss. You can't keep, these are different conditions of the market. So you have to be able to be versatile and be dynamic. And predetermine your entry, where you want to enter the trade, and your exit. Your exit is made up of two zones, your profit and your risk, where you want to exit in profit and where you want to exit if the market goes against you. And finally, risk management. Big on this. Your risk, especially if you're a beginner trader. As a beginner trader, if you want to go hard, you definitely go home, because you don't really understand risk management. You first need to it's just like a baby wanting to run without learning how to crawl and walk. You'll make a lot of mistakes. You might eventually make some profit, but you won't be consistent with it because you don't know how to manage your risk yet. If you keep risking 50%, 100%, you're basically gambling in this market, and you're, setting the account for to be blown in a couple of weeks, days, who knows. You can do that when you understand how risk management works and you're cool with, playing around with that account or just playing around with your risk tolerance. That's fine. But if you're just getting into this market and you want to understand how the Forex market works and you want to have a strategy, develop an edge, be successful in this business, you can't be risking 50% on a trade. So That's what it consists of, and it's suitable for all kind of traders. If you're a day trader, a swing trader, a scalper, a position trader, you should and you can use the zone trading strategy. The reason is because there is always a supply and demand zone on all time frames. Even in the 1 minute time frame, there's a supply and demand zone. On the monthly time frame, there's a supply and demand zone. When do you use it? During volatile sessions, like overlapping sessions, when the London session overlaps into the New York session, you can use that. After major news events, only because when there's news events, when news event happens like this, there tends to be wild movements up and down. So you wait for that to settle down, and then you trade the clear trend. If you're following, please let me know in the chat. If you're following, please let me know in the chat. If you're following, please let me know in the chat. So initially, I mean, when this session started, I asked you guys if you know how to use the economic calendar, and most of you said yes. Some of you said no. This is the Octa economic calendar. To access this, you have to go to the Octa official website, or you can go through your trading app. And if you're going through the website, just click on analysis and education. You come down to economic calendar, you click that, and it takes you to this page. If you're using your mobile app, your Octa trading app, you can go to the navigation section and you just see economic calendar right there. All right. Now, today we had quite a number of economic events that would influence the pound sterling. If I set this to medium impact, you'd see that we had some other ones that would impact the dollar right here. This brought about some volatility as well, little volatility to the market. But I'll just explain how this economic calendar works, and at your own time, you can practice it and get good at it. All right. Okay. So first, you want to make sure the time range is correct, so you don't prepare for an event that's going to be happening tomorrow and think it's today. Your time zone should be correct as well, your current location, so you don't miss out on the timing of the event. For filters, if you're a beginner trader, you can include low and medium, keep it this way, so you can get knowledge on low impact events as well, understand what it means, even though they don't bring about any impact to the markets, but just for the knowledge. Medium, just like the name goes, brings about medium impact or medium volatility to the markets. And then high impact, obviously high volatility to the markets is expected. But for today's live session, I'll just keep it at high. And I'll just brief you guys on what these events are, what they mean. AUD trade balance, 2:30 a.m. in the morning. Octa gives you the definition of this event, and not just the definition, but also the influence, right? So you click on it, it tells you what the trade balance is. If you don't know what it is, the trade balance is the difference between exports and imports, right? So it's the difference between what Australia exports and what they import. A positive number like this one means that the country is exporting more than it imports, and this is great news. What this means is that foreign buyers are paying for Australian goods. This brings more Australian dollars into the country. So previous was 2.2 billion Australian dollars, forecast 3.2 billion Australian dollars, and then we have the actual, which is 5.3 billion Australian dollars. This is also important for you to note, because the actual, the focus on the previous, because when you want to understand the influence or the impact of this report, you'd have to compare these three. Most people just compare the actual with the previous, but I also look at the forecast as well and compare three of them together, right? Now, I'll give you an example. If the forecast was 3.2 and the actual came way more than what was forecasted, right? It doesn't just mean positive for the Australian dollars, but really positive for the Australian dollars, because it was more than expected. So you get to understand the impact. If it came out to be 3.251, it will be good, but it wouldn't be as good as this. So it's important that you also know that you're not just focusing on the actual and the previous, but also the forecast. It's like saying, oh, Nigeria is going to be playing a football match with France, and then people are forecasting that the football match is going to end 2-1. France would win Nigeria 2-1, and then the match is over and Nigeria wins 4-0. The feeling you'd get from that would be different, because number one, you didn't expect Nigeria to win. Number two, the win was not even 1-0, 2-1, it's 4-0. It's a lot. All right, so that's just like a brief or an analogy to help you understand how the actual and the forecast are also important, not just actual and previous as well. And then we had the Reserve Bank of New Zealand inflation expectations. When you see MOM, it's month over month. When you see QOQ, it's quarter over quarter. But just to wrap up with Australian trade balance, more demand for Australian good means more demand for the Australian dollar. So if a lot of people want to pay for Australian goods, it increases the value of the Australian dollars. All right, let's look at the inflation expectations from the Reserve Bank of New Zealand. Now, this report basically shows you what economists, businesses, investors expect inflation to be in the coming quarter. Remember, it's quarter over quarter. It's like a weather forecast, actually, not the inflation itself, but it just tells you what people believe is coming. Now, the RBNZ, which is the Central Bank of New Zealand, I would say, they watch these expectations. If people are expecting higher inflation, the central bank, which is the RBNZ, they may increase the interest rates to stay ahead of it. If inflation expectations are low, or if they are steady, the Reserve Bank of New Zealand is more likely to leave things unchanged. Now, if you look at what happened today, you see we had a 2.28%, which means this report barely moved. From 2.29. So what this means is that inflation is expected to stay under control, and the Reserve Bank of New Zealand may not even rush to raise or cut the rates based on this report. All right. And then we had quite a number of economic events which are almost alike, but just they have different meanings. I'll explain them to you guys, because obviously you can see they came out at the same time. The Bank of England interest rate decision. Let me know in the chat if you guys are following. Let me know in the chat if you guys are following. Very important that you understand how to read the economic calendar, because this is a major driver of the market. All right. So what does this mean? What does the BOE interest rate decision means? The Bank of England cuts interest rates by 0.25%. What this means is more money becomes cheaper to borrow for businesses, but when people want to invest, when people want great returns, it may not be good for them. The previous was 4.25, the actual was 4%. So the Bank of England cut the interest rates by 0.25%. So it's cheaper to borrow now. But if you're an investor, it's not good for you, because now you're getting less than this. Now, what you guys need to understand about this report is when the interest rates are low, it makes the currency less attractive. If a bank gives you 4.25% return and another bank gives you 4% return, you're going to move your money here because you're getting more returns here, right? So the same logic applies with the currencies. Investors chase higher returns. Then we have the BOE. Whenever you see BOE, just know it's the Bank of England. Monetary policy reports. Again, you can always read this to understand what it means. It just shows you what the Bank of England is thinking, how they see the economy, the inflation, jobs, global risk, all these things. They give you the report and explain what was said during the meeting, right? That's what it is. And then we have the monetary policy, the first one was the monetary policy summary and the report. Both of them the same thing, right? This is the meeting minutes. They give you exactly what is being said in the meeting. Both of them the same thing. Then we have BOE MPC. MPC is Monetary Policy Committee, right? The BOE MPC votes rates unchanged. Now, if you don't know what this is, the Monetary Policy Committee is a group of 9 people. And these 9 people vote on interest rates. So the previous time, it was 6 votes, and actual is 4 votes. It was forecasted to actually be 2 votes, but actual shows 4 votes. 5 wanted to cut interest rates, 4 didn't want to cut interest rates. And when you have a close vote like this, 5-4, it just shows some kind of uncertainty within the central bank. Some people think, or some of them think things are fine. Some of them are cautious. 5-4 is really, really close. The previous was 6-3. We're having 5-4. It's really close. So I expect GBP to become very jumpy. You know. BOE MPC vote rate cut. Again, same thing. The interest rates are set by the Bank of England's Monetary Policy Committee. They set an interest rate, and the judges, the MPC set an interest rate. The judges will enable the BOE inflation targets to be met. It's comprised of 9 members: the governor, the 3 deputy governors, and the bank's chief economist, and 4 external members appointed directly by the chancellor. You can see 5 wanted to cut, 4 didn't. Let me know in the chat if you guys are following. 4 people wanted the rates to be unchanged. 5 people wanted the rate to be cut. Let me know if you guys are following. The last time it was 6 people that wanted the rates to be unchanged. Only 3 wanted a cut. It was forecasted that 7 would want a rate cut and 2 would want it unchanged. But the actual report shows that 5 people wanted a rate cut and 4 wanted it unchanged. Like I said, guys, when the votes are this close, it shows uncertainty within the central bank. And yeah, the meeting minutes, I told you guys about this as well. The speech by the Bank of England's Governor Bailey is just, so basically after all the data and the decisions, he steps up to speak. The governor steps up to speak. It's just like saying, you know, when you play a football match and then, you know, they want to interview the coach and, you know, get him to talk about the playbook, what's happening, what they'll do the next match, blah, 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 blah. That is what this is. And this is also important. If you follow this news, you also get some kind of understanding, because sometimes the governors can sound calm, sometimes they can sound optimistic, sometimes they can sound cautious as well. So you pay attention to the things that they're saying. If they say things like, or if Governor Bailey says things like, oh, they would need more rate cuts, then GBP could fall. Okay, I'm seeing your messages. Everybody's following. Guys, very important as well. If you have any questions, please let me know in the chat. It's important. I need to be sure that you guys understand this explanation. So if you have any questions, please let me know in the chat. And another thing, guys, let me know in the chat what favorite pairs you trade. Maybe I can just look at the pairs that you guys trade and call out a signal. So let me know in the chat, what pairs do you guys trade? Let me know in the chat, guys. Guys, we're seeing gold coming up, approaching 3,400 per ounce. I told you guys, I'm expecting gold to reach 3,400 per ounce by tomorrow. It's pretty close. We just need to close above these highs, and 3-4 is in sight, very much in sight. And if we break that and sustain the break above that, we're coming here next. We're coming for another retest up here. Gold is moving wild this here, guys. Everybody's saying gold. You guys want to trade gold? My bias on gold is already a buy, right? So the question would be, where do we get to enter the buy? Now, for me, if I'm going to be buying any asset, I like to buy at the pullback, right? I like to buy at the pullback. So when you hear buy low, sell high, that's what it means. In an uptrend, you don't want to be buying at the highest point because there's always the potential for a pullback, a potential for a retracement, right? You want to buy when the market pulls back into a potential key level. I already see a zone here. I'm just going to use the line for it, not the zone tool instead. I see another one here. And guys, this is on the lower time frames, right? And I'm doing this on the lower time frames because the targets is not really much. We're looking at about 90 pips on gold or about 80 pips to get to 3,400. I'm not really going to push for a buy here just because we're still testing resistance on the lower time frames, as you can see here, and there's still potential for the market to push back into these zones. So what I'm going to do is to identify this level of interest here. I can still extend it all the way up to this point as well. You can see why it's important for me, because we had retest here, 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 and here, right? Not really ideal to go into a buy right now on gold. The zones I want you guys to look out for, you can place a buy limit in those zones, right? You can do a minor entry here at this zone. I'll type it out for you guys anyway. There you go. I would even take out this one, just because I think gold is going to push back down a bit more before we see any push to the top side. But yeah, this can be a minor entry. The entries I'm looking out for is here all the way down to here. But if gold successfully breaks below this point, guys, we'll take our eyes away from 3,400 for a while, right? If we get that nice break below this point, we'll take our eyes away from 3,400 for a while. But as long as we stay on course and we trade around these zones, we're pretty bullish on gold. Way bullish on gold. Again, this is the target, but just because we're looking at about 90 pips, we don't want to capitalize on that. If we take that trade right now, our area for stop loss is going to be really high. We're looking at about 80 pips, 1-to-1. I want to enter at the most comfortable position, which is not here. This is a resistance level, right? We can't really enter right here. We need to wait for that market to pull back, and I can call this the observation zone, right? This is not an entry. Let's just call it the observation zone. If we get bullish momentum, then you can do minor entries, but I'm more comfortable here, here, and maybe even here. But as long as we stay trading above these zones, gold is still bullish, right? As long as we stay trading above this zone or in this zone, gold is still bullish. So for you guys that, oh, someone said they can't see the buying points. For you guys that wanted the trade idea on gold, there you have it. That's your trade idea on gold. And if you have any questions, please let me know in the chat. Go ahead and ask your questions. I'm constantly checking to answer all your questions. I told you guys I was going to talk to you about your strategies and how you can improve on that. If you're, if trading is more like a roller coaster for you right now, I need you to know that you're not behind. You just need rhythm, not to rush every day. Now, a lot of beginner traders, they secretly feel like they're late. Like everyone else is flipping accounts, everyone else is withdrawing daily, living the lifestyle except them. But guys, I have to tell you this. One, there is no late comer to success, and your journey is still valid, even if it's slow. It's not about who starts fastest or who starts the fastest. It's about who finds their edge, finds their rhythm, and sticks to it. I know you guys have heard this thing from me a lot of times. Trading is not a sprint, it's a marathon. It's a personal rhythm of growth, patience, and emotional maturity. So you have to remind yourself that you're not late, you're learning at your pace. It's okay to still be practicing, building your edge, building your strategy. Don't go out and start judging your page 1 by someone else's page 20. Okay? Second thing you want to do is to focus on rhythm, not rush. Now, if you don't know what rhythm is, I know I always tell you guys about rhythm. Let's ignore this part, right? This was from the previous one, just a typo over here. But rhythm is when you trade at a pace that you can manage emotionally. Some people succeed trading twice a day. Some people succeed trading 5 times a week. But you want to focus on building habits that last, not just to get rich quick overnight. Don't see trading as an escape plan. It's a skill, and skill grows best in rhythm, not in chaos and rush. So what does rhythm look like in real life? You set a time, you study your charts daily, even if it's just 30 minutes, 1 hour, 2 hours. You trade only in a session that fits your life, right? If you know that you're going to be doing a 9 to 5 and you're going to be busy at work, you can trade the Tokyo session when you come back. You can use pending orders. And don't compare growth. Like I said, don't look at your page 1 and compare to another person's page 20. All right? You want to embrace slow growth. Slow growth is real growth. As long as you're getting 1% better every day, what you build slowly, you understand deeply, and what you understand deeply, you don't lose easily. All right? I know that you guys admire a lot of traders out there, but you have to understand that they built their system. You have to understand that these traders built their system, mastered their mind, and grew gradually. Okay, so I just wanted to quickly talk to you guys about that. And while you're still at it, remember that you can trade with the Octa trading app. Everything that you've learned today about the zones, the key levels, download the Octa trading app. The link is going to be in the description. It's also going to be in the chat as well. You can download the app. It offers a wide range of trading instruments with low spreads, fast execution, and zero commissions, right? And no swap, right, guys? No swap. It also has various educational resources like these webinars, 24/7 customer support, not just the webinars, guys, even readable articles and books, and also videos as well. 24/7 customer support and a strong commitment to funds and data security. Now, if you got up to this point, congratulations. You get to see the promo code that gives you a 100% bonus on your deposit. You can take advantage of this promo code in 5 steps. Use the Octa Trading app or the official website. Go to your profile, find the promo code section in the menu, and type in Ambrose E100, and you enter the promo code and click on activate. You can make your deposit and enjoy your bonus. Today we analyzed trading instruments to understand how they behave under various market conditions, supply, demand, review your actions as well, and reflect on your decisions to identify what worked well and what can be improved on. Remember, I talked to you guys about slow growth and also getting your rhythm, not just rushing. Use the economic calendar and also the Octa trading app to keep up with the latest market news and updates, and use the educational resources like this video you're on, to enhance your understanding of trading strategies and tools. And guys, you can always come back to this video. It's going to be saved in the Octa Broker YouTube channel. You can come back to this video to rewatch and refresh your memory. You can also check out other videos by other trading experts as well. Learn the strategies and see how you can use that to improve your trading as well. Now, if you've got questions for me, please let me know in the chat. If you have questions, let me know in the chat. The reason to buy at those levels are because they are key levels for me. Like I said, this is a minor key level. I call it the observation level. It is not in my, I don't buy high, I don't buy at the resistance level. The idea of chasing an uptrend or chasing a bullish momentum is not to buy high, but to buy at the lowest price possible, right? The lowest and the most comfortable price. And obviously, if you're going to be buying something, the lowest price can never be high. The most comfortable price can never be high, right? So because we are looking for buy opportunities to trade gold to the upside, I told you guys gold is pretty bullish even from the higher time frames. We've seen it. We've seen gold going back to make a retest as well. Fundamental support gold, technical support gold. What we're just doing is to capitalize on that move to the top side without having to buy at a high price, because you don't want to fall the risk of a potential pullback before the market now decides to go to the top side. We've seen it happen. We've seen it happen. Imagine you bought here and then the market pulled back. Imagine you bought here again and the market pulled back. And now we're back here again. This is a resistance level. It's a key level, right? You can just start buying high, okay? So this is our observation level. This is my minor key level as well, where I'll be, comfortable to execute trades. Early entries with low lot sizes. But if we break below that, then this is the last place I'll be looking to buy gold from. And whatever happens here, we're still bullish on gold, but if we break below these zones, we'll just look out for potential drawdown a bit before gold moves back up. But the 3,400 that we have in sight would have to take our eyes away from that if gold breaks below this point, right? We won't be expecting gold to move back down there in a short while anymore. So for Akinola that asked the question, I hope you got your answer. If you didn't, still let me know in the chat as well. And guys, if you have any other questions, please let me know in the chat. If you have any other questions, please let me know in the chat. All right, guys, we value your feedback. I mean, I know your questions can still be coming, so still type them in the chat. But after this session, I would like for you guys to take a moment to fill out our survey. We value your feedback, and it's very important for us to improve our future webinars. So it's going to take just 1 minute. The link is going to be in the description. It can also be in the live chat as well. You can use that to give us our feedback so we can improve our future webinars for you. Questions, guys? Okay, so one of the ways someone is asking about SL, One of the ways you can identify your area of stop loss, I'll just keep it really simple because of time, would be, especially on the lower time frames. If you're looking at the lower time frames, you can use swing lows like this, right? So if you're going to be entering a trade here, which is obviously going to be a buy trade, and remember, the market has to get here first and show you bullish momentum. If the market shows you the bullish momentum around here, you can still hop on that trade, but your stop loss should not be more than here, right? But the market has to show you bullish momentum first. Sometimes we could get a break below this point, 3,380, and the market just retest this trend line, which is also going to be a liquidity grab over here. And then in that case, your stop loss would be just below this point. But remember, your target is 3,400. You can place a couple of trades within your risk management or your risk tolerance and take out profits here, take out profits here, and then maybe the final targets can be here at 3,400. So let me know, and this would be a very nice 1 to 5.5 risk to reward ratio. I didn't show how to mark the key levels and what time frame. So this is the 15 minutes time frame, and we're on here because we're looking at the possibility of gold getting to 3,400, which is pretty close, 90 pips. We can't really see that from the daily time frame. The daily time frame is going to show us the overall bullish momentum that we have on gold. As you can see, trending to the upside. Today opened really bullish on gold as well and continued to stay bullish. So we're not going to be going against that. As you can see, yesterday was a bit bearish, but today opened bullish. Closed, well, will close potentially above this previous bearish momentum candlestick. Now, I would even get more confirmation if we close above this one, because this is our previous high for the past week on gold. This is the previous high. If we close above this, I would get stronger confirmation that we're getting to $3,400 per ounce on gold, right? But the idea is to pretty much, and I said this at the beginning of the session, identify overall market structure, get the overall direction of the markets, identify your supply and demand zones, so that when the market is trading, you know where it's going to, where it's headed, and how you can follow up with that on the lower time frames. All right. Now, if you have any more questions, you can always ask on the chat. If you're joining after the live session is done, you can still use the comments to ask your questions. Right about now, I'm going to be ending the session, but I would love to leave you guys with this. Every trader you admire, or the trader you have in your mind that you want to be, the kind of trader you have in your mind that you want to be, you know, making profits, entering trades at a very clean and precise price point, moving with confidence. That trader started where you are right now. At some point uncertain, at some point frustrated, sometimes overwhelmed. I've even been there. But the difference is they stayed in the room and they showed up to sessions like this. And after these sessions, they learned the reason behind every move, not just how it's moving. Because a lot of times you guys learn only the strategy, how, but you forget to learn why. So even if you didn't place any single trade today, you gained knowledge, you gained clarity, and that's growth. That's the progress you need. That's the kind of step that builds up and compounds into real skill. So again, you have to remember, you're not behind, you're building rhythm, and rhythm builds mastery. So keep showing up for these sessions, keep showing up for your practice and your training. Commit some time to learning how to trade, because the market doesn't reward speed, it rewards understanding. And I will tell you guys that every single day you learn, you're doing better than you think. Thank you guys so much for joining.